everyone. Hey, thanks for joining me today on the Central Coast Market Update podcast. I'm here today with Zoe Raithel at her beautiful Paso Robles office on Spring Street. And she's here today as our local expert to tell us all about the lending side of what's going on with rates, etc. We're going to go over some really great content and information today. But first, I would like Zoe to tell you all about her and her experience and all of her years. She's been a local lender for quite some time. So tell us all your credentials, Zoe.
Well, thank you for asking and thanks for having me, Cindy. It's awesome. We've been planning this for a bit. And so it's probably never been a better time than right now to talk about this because there's a lot of, confusion, concern, people looking for some clarity. And so I'd love to share that with you. So a little bit about my background. I've been in the mortgage business a little over 20 years. Wow. All here locally in the Central Coast. And I really, my backstory really is kind of interesting. I got into mortgage really by visiting it the first time, not as a lender, but as a consumer. I was in my 20s. We were recently married, my husband and I, Kirk and I, and we had, finished college, gotten married, started our jobs, and he came home from a chiropractor's appointment one day and said, "Hey, Dr. Dean wants to sell us his house." And I was like, that was not on our radar. I mean, I guess it should have been the progression of life, but in the mid-20s, I was not ready.
Right.
I hadn't saved money. We barely got our job started. Credit, I don't even want to talk about it. Not. And he just said, "Hey, my husband, he was like, why don't we at least just talk to this lender guy he gave us a name of and just see if we can make it happen." And this guy was from World Savings. Do you remember?
Oh my gosh,
World Savings.
Years ago.
And he helped us in so many ways. He was a magician. I mean, like I said, we really were not ready. But every challenge, he gave us an option, a strategy to overcome it. He was a magician. He was a therapist. I mean, at night, I was crying. I was just emotional. I was just like, And that guy worked with us through the whole way, helped us buy our first house, and really, honestly, changed the trajectory of our lives by being able to be homeowners so early in life.
And we've been in our 20s.
We've been a homeowner ever since. So sadly, however, that was about the only time I had that positive of an experience with a lender.
Understood.
Fast forward, when we were moving back, that was in the Bay Area. When we moved back here in '99 to Paso Robles, we had 3 young kids, 5, 2.5, and a 6-month-old. My husband had gotten a job here. He was already working. We had sold our house in the Bay Area. We were, it was a scurry. It was a scurry to get me and the kids down here. And our lender we were working with here in Paso Robles literally went MIA in the middle of our transaction. I didn't know if my rate was locked. I didn't know if we were going to close the loan documents.
Not good.
It was so scary. And so anyways, the background of what I'm getting to is that I really felt like there had to be a better solution for good people that want great assistance and guidance and strategy. And so I moved into the mortgage business in 2003 and providing that level of service to everybody. And I think that's what I'm known for, is just being able
100%.
to hold someone's hand, whatever it is you may need. Do you need options? Do you need strategies? And just be that different, an elevated level of mortgage. And so here at Cross Country Mortgage, the platform I love, we are the #1 lender in America today by volume. Bigger's not always better, but at this point in the game, with the way that economics and the financial markets are working, I really feel good about being on a very big and strong ship financially.
That makes sense.
So, and then as the biggest lender, just about any loan product available. So everything from reverse mortgage to a construction loan to, I'm helping somebody with a bridge loan right now where they can buy a house without having to sell their current home. So I have every opportunity to help clients get and achieve their goals. So that's why I'm here and what I do.
That's so great to know all that experience and what you do, because a lot of folks out there, a few of them are working with you right now, but they need to know who to go to and that you do those kinds of loans. So that's very cool. That's what we want, someone with a lot of experience that knows the market. So that's awesome. So what we're wanting to know today, a few questions for you. Rates, interest rates, that's what we're here to talk about. But so many of us, including me, you're the expert. And a lot of us, we're so focused on the feds. Clearly we peaked out at 8% or close to that but they came down without the feds doing any cuts. So many of us, and I know it's probably a deep rabbit hole, but like some explanation for a kindergartner, how that all works. They came down without the feds doing any cuts.
Yeah.
And I know there's external things happening there, but can you explain that a little bit?
Yeah, you bet. So it's not, I guess, unique that people think that the Federal Reserve, the feds, dictate rates, which they do, but that rate is the federal funds rate.
Okay.
So that's different. That is the rate that banks are charging each other for short-term loans. So it's not the same as mortgage rates. Mortgage rates are really market-driven. And so the difference is that they might go in alignment with each other. It is often the case that when the federal funds rate is dropped by the feds, that mortgage rates also follow suit and come down.
Mm-hmm.
But we have found in this volatile environment that we're in, that doesn't always follow suit.
Right.
So how does that work exactly? So think about it this way in terms of our mortgage rates, of whether they're going up or they're going down. It really is based on how people feel about the economy. Okay? So if people are feeling the economy is going well, jobs growth, good, economic growth, good, a lot of people are putting their money in the stock market to grow their wealth.
Sure.
Over time, investing in the stock market. It is often at times where we're feeling that the market is not maybe going as well, possibly with a recession or lower wages, lower employment, that we move out of stocks into bonds. Does that make sense? Bonds
Yes.
are seen as more of a safer bet.
That's what I've heard.
Right. So what happens with mortgage rates is they follow more the bond market than the stock market or the federal funds rate. So the bond market is what dictates what we're bringing out on a regular basis in terms of mortgage rates. So again, just because the feds lower the rates or they don't lower the rates, it really is more related to the market and how people, investors, are feeling about the economy and where they would be best suited to put their dollars.
Got you. So when the feds do any kind of a cut, it's not immediate, like a lot of us think. Or you did say sometimes it is,
Well,
most of the time it's not.
Yeah, the federal funds rate will dictate and will have an immediate effect, or almost immediate, on things like auto loans,
Okay.
credit card, because these are coming from the banks. They will
Gotcha.
immediately lower because it lowers their cost, the bank, their money, so they can have lower auto loans, credit cards, to some degree the home equity lines of credit. Those certain things are affected immediately. But again, it is not related to mortgage rates. Mortgage rates are based on the market and how people are feeling about that particular investment.
It's so great for you to clear that up because so many of us just focus on what the Federal Reserve is going to do and what they're going to do with that. Do you feel that the inflation, does inflation, because they keep honing in on that, and it is high. There's core inflation and there's headline inflation, which I've talked about in different podcasts, but that doesn't seem to have directly affected mortgage rates, does it?
Well, it does, and here's the best way to explain what that is. So again, we're talking about investing, right? Where we're going to put our money. All right. So let's say I came to you and I said, I'd like to borrow $100,000. Where is it? No, I'm kidding. and you say, I'll lend that to you at a rate of 5%. And I said, okay, that sounds good. Because to you, $100,000, that would give you $5,000 this year.
Right.
And then that's going to pay your property taxes, or that's going to, that'll help you with your groceries. You have a certain expectation of what you can use with that money that I'm paying you, the interest. Okay?
Yes.
I will lend you that money. You pay me $5,000 a year, and I'm happy with that return. Okay. But now you're looking out at the future, and you're like, well, wait a minute. With inflation going up, and with cost of goods going up, will that $5,000 I'm going to make on this actually buy me the same amount of what I was going to use it for? So if you had thought, oh, wait, that buying power is not going to be the same next year. I thought 5% was great, but I think I really need 6% to make it make sense, because out on the horizon, I see that goods, the things I'm going to use for my wins, my interest that I've gained, is going to cost me more, then this 5% is not enough. I need you to pay me 6%. I'm giving those as examples.
Right. No, that's making sense.
So that's why on an inflation, when we had inflation going up, that's why you see mortgage rates going up, because investors want a greater return, because they see that they need a greater return to basically make it make sense to lend.
I understood it completely so much better than even, I could go into podcasts and say, these are the numbers and this is what happens, but that's why it's so important to talk to an expert that knows this part of it, because that made a lot of sense to me.
Oh, good.
What a great explanation. No, yeah. And I'm not, I'm more of a kindergartner when it comes to that.
No, if you can talk about it just because I've been doing this for a long time, you still have to get your head around it and be able to feel comfortable in your own head about how this works.
Yeah.
It doesn't really, the honest truth is, there's plenty of people way above my pay grade that can't predict or expect what's going to happen next either, right? So we just try to get it to a level of what makes sense to us in our core of how I can understand this. This is my business, so it doesn't matter about it does, but macroeconomics and all these gurus that are telling it, you need to understand it from your core, from your street, and on Spring Street in Paso Robles. How can I understand this personally?
Right.
So I can explain it well, and that's just the way that I've come up with it, and now I've got my head around it, I can help other people.
And that's what I love about you, Zoe, is you explain things. Like Zoe's helped me personally with a loan, and I understood more than I ever have talking to anybody else. And that's one of the things, many things I love about you. You will understand everything when you're working with Zoe about the process. So getting on to another question for you, the tariffs. And this is not a political question in any way. Just, it's out there. People are concerned about it. How do you see those affecting interest rates, if they do, or the lending industry as a whole?
Yeah, so it goes back to what we just talked about, okay?
Yeah.
I am an investor. I'm concerned about what cost of goods will be in the future. That's tariffs.
Yeah.
Are my goods going to cost me more? Whether it's short-term or long-term, that's another topic, but I'm concerned, right? So that clarity is not there, so I feel like I need a higher rate of return to invest in these types of securities.
Because you're seeing that, like you said, on the horizon. That makes a lot of sense.
That's exact. So that's how tariffs could affect what's going on.
Yeah.
And now what could also happen is that, again, with concerns and not being confused about what's the future going to look like for investments. Some people, you saw this a week or two ago, and it continues to be volatile. The stock market itself, the big drop, people pulling out, oh my gosh, what's going to happen next? It's not about reality, it's more about fear. But that sometimes is the case. We make decisions on fear sometimes.
Right.
And so sometimes when people pull out of the stock market, we circled all back to the beginning of our conversation, they move over to the bond market, and sometimes that helps us. That's what we were talking about. How is it then? Inflation's been here, tariffs have been here, the Fed hasn't moved. How is it that interest rates have come down a little bit?
Right.
And that's why there's just been more money coming into that area, with people wanting to pool their funds into an area that is seemingly safer at this time than the stock market. But that's day to day. It's really interesting.
It does change a lot, right?
It does.
Are you seeing the rates be as squirrely as they were? Are they kind of evening out? Like, for instance, when you look on the news and stuff, you'll see a 6.8 or 6.7 for the 30-year fixed.
Yeah.
Which, there's a question on top of that question, but are you seeing those rates be real squirrely or kind of stabilized?
Yeah, when you think about it, yes, they're around 6 3/4 today for a 30-year fixed and, good credit and that kind of thing. Mm-hmm. So what you're seeing in the news is really just, we know this about the news. It's a lot of it is noise, and it's just to, clickbait. What is that? What is that? What is that? And so are they moving around every day, even within the day? Yes. But does that movement that's in the background, the pricing, does that really change your rate significantly on a day-to-day? Not so much.
Okay.
Right? It's incremental. It may not even change it at all.
Got
okay?
You.
But I will just give you an example. It was just hilarious that I knew you were coming in today. And so I watched a certain thing, essentially it's a podcast, but anyways, in the mornings, about what's happening today, right? In the markets, mortgage.
This minute.
Yes, right now. And the headline was, lower rates may be on the way. That was the headline. And we can talk about why they said that. I'm not joking you. Within a couple of hours of that, I have an email saying rates have deteriorated.
Don't get all excited for 1 minute, right?
So, I mean, the thing about it is, so yes, it's dynamic, but really, when you're talking about one person's loan, they're not right now moving from 6.75 to 7.25. It's just not moving like that.
That's good to know. And that was my other question. Like one size does not fit all. So there's some factors right there for each buyer. Like say the 6 point whatever and 6 3/4, whatever it is, doesn't apply to every buyer. Would that be a true statement?
100%. So that's what makes me laugh when someone calls and says, "What's your rate today?" And I'm like, okay, I almost have. I mean, I can skinny it down, but I have probably 7 to 10 points that I need to know what your rate is, and it's not just
as the buyer.
Right. Well, for me, the lender to give an accurate rate quote, which is I'm all about accuracy. I don't like smoke and mirrors. I just want to say what it is. So the accuracy really relates to the loan amount. Is it a conforming loan amount, $200,000? Is it a jumbo loan amount, $2 million? Totally two different loan products. So two different loan types. So two different interest rates. How much are you? If it's a purchase, how much are you putting down? So what is my purchase price versus loan amount?
Mm-hmm.
What is your credit score? Do you have traditional qualifiers, like I'm using your tax returns to qualify your income? Or no, I have other ways of qualifying your income, but it's not traditional. What if we have some problems in the past with credit? Mm-hmm. Maybe we're looking at an FHA loan. Maybe you're a veteran. There's so many different factors that really guide you in a variety of different ways that your rate could be as low as 6.5 or as high as 7.5. It really is, but for most people that are looking for just a traditional loan, they've got a little down payment and reasonably good credit. You're looking at 6.75 to 6.875 today with 0 points. But then that's the other piece of it. You will notice when you look online sometimes at rates or get a quote for somebody, especially online when they don't have a vested interest in the community, you'll see 6.25. And you'll say, wait a minute, Zoe, how come you're quoting me 6.75? I can get 6.25. Well, I can get you 6.25 as well. But you need to get the whole fee sheet together to understand that is paying points to get your rate down to a different level. Now sometimes that might make sense, but what I do with my clients is look at all the options. What are we today with paying 0 points? What are we if we paid 1 point or 2 points? What's the differential on monthly payment? So in other words, what's your savings? If you have that lower rate, how much are you saving per month? Mm-hmm. And then we say, well, if we're saving $50 a month, I like $50 a month, but I'm paying $3,000 to save $50 a month, does that really make sense? Yeah. Right? We talk about things like that when I work with my clients.
That's great, yeah. And I think there's a lot of confusion with that. Again, online rates, a real person rate. There's so many teasers and things like that don't get you what you think you're getting.
That's correct.
So and that's just really great information. That's why you want to talk to someone like Zoe that knows what's going on. So you talked about some programs, different kinds of loans for different folks. For the first-time home buyer, it's really tough in our county and across the board, really, in the United States.
It really is.
The down payment assistance, that's still in effect, where a first-time home buyer, or someone with not as much funds, can qualify for that. But I'm sure there's requirements.
Sure.
And go ahead.
Yeah. So down payment assistance is always an option. I actually am a preferred lender for a couple of different programs through the state of California. And so down payment assistance can also help you with closing cost assistance, so it can really minimize your funds needed to close. So that means, what you need to bring to the table can be very limited with down payment assistance. But just like your mother told you, sometimes Things are not always as they appear. So the reality of that is a great program and a great opportunity for someone who would absolutely never get into a home otherwise and can afford a monthly payment, but they just can't get that down payment because we've got rents that are high. And I'm paying all my money in rent. How am I ever going to save any money? Gift funds from family. There's absolutely no, my family's tapped out. There's no way I can get a gift. If there's no other way to get into a home, then that's a great opportunity for people. But the downside really, if you want to call it that, is they do come with higher fees, down payment assistance, as well as higher interest rates.
And is that a separate payment from your mortgage payment, or is it all rolled into one?
No. The down payment assistance is going to be a traditional loan. You're going to have a first mortgage that you pay every month. The down payment assistance part of it, what you did not bring in, will reside as a second mortgage on your home, but it is what we call a silent second, meaning you're not making payments. You could, but you don't need to. For the life of the loan. Then once you either refinance and pay off that loan, which you can do in the future, or you sold the house in the future, that's when you pay back that assistance you got at the beginning.
Really?
Yeah.
Wow, great information. I did not know that. I thought, and many people think, well, that's going to be a second payment I'm going to have, or on top of my actual original mortgage payment.
No.
So that's great. That's great information. Awesome information. Another thing I wanted you to touch base on, and where you're going with that, as everybody knows, there's been a lot of changes with real estate and representation from realtors, and there may come a time when a buyer needs to pay their agent because maybe a seller won't, or there's a lot of the competition. My whole thing is if there's a lot of multiple offers on a property, a buyer may want to stand out and pay their own agent representation. However, they may not have the funds for that. I'm sure you've probably prepared for this, or have something that you can explain how that would work as a on their loan, and how that would affect that if they needed that from their lender.
Yeah. So the way that works, it's going to be hard to just explain it in words. Right. I explain it with a show tell piece, so we can look at all the
visuals. That's what I need.
Visuals. But the reality of it is, let's say someone came in and they said, I've got 20% down to buy a house for $750,000. Okay? And then you say, hey, it's really competitive. Can you guys come up with the remainder to pay my own buyers my fee? I'm the buyer's agent, Cindy, and if you paid my fee and we didn't have to ask the seller for it, I think you could win this deal. And they say, I've got 20% down. I don't have more than that.
Yes.
Then what we can do is, on the lending side, is you do not need 20% down. I actually have a 15% down program that doesn't require mortgage insurance. So really? What we do is we kind of just move, again, it's easier with visuals.
Right.
I'm going to use my hand as a visual.
That's okay.
So it's the shell game. No, I'm kidding. We're moving monies around. So instead of putting all the 20% towards the down payment, we're going to only put 15% towards the down payment. Not that you get 5%, but I'm just saying,
no, I get you.
You're using some of the monies you are going to use for the down payment, and you're going to say, I'm paying my own buyer's agent, so seller, you don't have to. So seller, I should be top of the rung for the offer. So it's really what it gets down to, and that's why we're here today. I think part of it is really getting together with a team of people that you trust, that you've got an agent that knows what's going on, right, that knows what's happening in the market, that can say, hey, you want this house? I think we can win this offer. This is what I think we're going to need to do on it. Let's do a game plan with Zoe, your lender, to see how this all works together. So it's often the case that it's not just, we're in silos where you're talking to your person, then I'm talking to your person, and then, that's not how, it works often very well when we're all sitting down together.
That's right.
And it doesn't mean to say that there's any private information that's being, it's talking about strategy and how we can work this deal so that everybody gets their goal achieved.
Right.
We all want to win. Our clients want to win the house. We want to win the deal. Everybody wants to win. How can you win? And so what you do is you go into the locker room and you create a game plan.
Yeah, you go and strategize. That's for sure. So when you're talking about you're just saying about moving money around, instead of the 20%, all of it there, some of it's going to go over here. to help if you needed it for your buyer agent, if I was representing you as a buyer.
Yes. Yeah. You just have to think about it in a different way. Remember, it's just like the rate. You got to get your head around it, and then once you have your head around it, and again, with the visuals I provide, it'll make a lot of sense.
Yeah, those explanations, Grimes. I love that. I'm learning, and this is great. This is awesome.
Good.
So, listen, we're going to put you kind of on the spot and say, what advice, Zoe, would you give buyers today on how to move forward, what they should do? Some buyers, let's go back for 1 second, are being told out there in internet land and maybe in the media, but their neighbor down the street, wait, everything's going to crash. Wait to buy. Wait to buy. What would your advice be, first of all, on the wait to buy or moving forward in this market?
Well, I did have a visual for us today, and that is, how do I know what's going to happen? I think, let's find out. Should I buy a house today? This one says cannot predict now. But I will tell you this, and I have graphs for this. I'll give it to you. You can share.
I would love to see it.
But the fear of a market crash, at least here on the Central Coast, it's just not going to happen. I don't know everything about everything. I'm going to admit that. Yeah. But here's the thing about what's happening in our market. There are not enough homes.
Right.
Inventory is still low, even though it's kind of perking up. It's still nowhere near the demand to live here. We have not done any large-scale building in years. So there are so many people that are our age or older that are living in the Bay Area, Southern California. They want to get their piece of paradise. So we have a huge demand to live here on the Central Coast. We love living here, darn near paradise. So when you have a disconnect between supply and demand, the values are just always going to be there because they're coming. People are moving to this area, and they're willing to pay. For them, it's a budget. It's great. It's a deal.
Right.
They're selling $2 million and buying $1 million.
That's true.
Cool,
Yeah.
So they're willing to pay what they need to pay to get it, and there's not enough homes here. So the values are really very strong. But you can look at history across the nation, irregardless of the Central Coast. And a lot of people are either predicting or saying we're already in a recession. Don't be panicked about that word. It just means a slowing down.
Right.
Every single time there's been a recession, values have stayed strong, and actually mortgage rates have gone down.
Really?
So the one time you can look in this entire spectrum of, 75 years of graphs of recessions, one time we had that market crash that everyone's fearful of, the 2008, whatever. Just remember that the housing crash at that time, that actually predated the recession. So the housing crash, created the recession, not the vice versa.
Right.
So there is really nothing anywhere that anyone can point to that's valid. History, graphs, data, mining, whatever you want to call it, that's going to say that the values are going to crash. So, getting in now is always better because it's probably going to be worth more tomorrow. Okay?
That's really true. And people that have waited have regretted waiting.
Yes.
Because like you said, the prices aren't going down, but you have all these programs and the interest rates will continue, in your opinion, to go down as much as you can. If you get the 8 ball, who knows? But
it's going to go down now. So what's I feel like is still a good bet is, and I tell people this: don't buy a house just to buy a house. That's not even what I'm saying. What I'm saying is if you're ready. So the best time to buy is when you're ready. Okay, got to be ready. Feel comfortable with the payment. So I pre-approve people fully. That means it's a little different than a pre-qualification. Pre-qualification just says, I make $100,000 and I've got $30,000 in the bank. Someone just verbally or just typing it in online. Rocket Mortgage, go.
Right.
Sometimes Rocket Mortgage crashes, right?
That's right.
Because it's garbage in, garbage out. So that's pre-qualification. A true pre-approval. That's what we offer at Cross Country Mortgages. We look at everything. We're pre-underwriting the file. So we are looking at. There's no hiccups during our transaction. So if I tell you you're pre-approved, you are ready to buy. Now, here's the monthly payment. Are you comfortable with that? Yes, we can do that. Yes, our funds are ready. Yes, if you're ready and you find a home that could work for you, sitting on the sidelines is not a good idea right now, because that home will be worth more tomorrow. Almost, you know, you can, it just probably will.
Right.
And then in addition to that, rates, while they are what they are today, and maybe we wish they were lower today, I do.
Right.
But let's just get in and start building
Right.
equity today. We can always look at refinancing in the future. I offer what's called a buy now, refinance later. And all that means is when we refinance, I'm not charging you all the fees again. So you have a low cost refinance in the future sitting out there. I continue to manage your mortgage as we move along and help you by saying, no, now's not a good time to refinance. It's not going to save you enough money. Oh, calling you and saying, rates have dropped. This might be a good time. Let's look at the numbers together. So we continue to monitor and make sure that you're in the best mortgage for you at that time in the future. But that's my recommendation. When you're ready and you've been pre-approved,
Yes.
and you find a house that can work for you, no better time than the current time to go ahead and just pull the trigger.
I like that, because that was a question I was going to ask you about refinancing, because the rates will come down at some point.
Yes.
But, and like Zoe says, you know, that's part of her job, that's part of having relationships, is she doesn't just do your loan and drop it, see you later, alligator. She's on it to say, like she said, and she has done this for several of my clients, hey, the rates are there, let's refi, come on in, let's look at the numbers. So that's what you want, a relationship with someone that's going to stay on it and care about you and your purchase and in the future. So it's one of the many reasons I love using Zoe. I really appreciate you being here today, so much talking to us and giving us so much great information. Her number and contact information will be on the screen at the end of this podcast. I really appreciate all of you joining us today on the Central Coast Market Update. Zoe, thanks again. And listen, you need a great lender with great advice who's going to be on top of it. This is my gal. All right? Thanks, everybody.
Thank you so much for having me.
You're so welcome.
Appreciate it.
Thanks, Zoe. Thank you.